We're back on Morning Trade Live. Let's take a closer look now at credit card stocks. Visa reporting earnings after the closing bell this afternoon, and Mastercard reports on Thursday. Those stocks are pretty close in performance over the course of the year. But if you take a look at this chart, Capital One and American Express are the outperformers in the space. Both of those names are up more than 20% in 2025. So let's go inside out on Visa and credit card stocks. Joining us now is Stephen Biggar, the Director of Financial Services Research at Argus Research. Thank you so much for your time this morning, Stephen. What are your expectations for Visa's report card today?
Yeah, hi, Sam. So I think, Visa's had a very remarkably consistent run of kind of high single-digit revenue growth per quarter, year over year, and they get that by the consumer spending, which tends to be between 3% and 5%, and then increased spending on credit cards and digital forms of payment versus cash and check. So and they turn that high single-digit revenue growth into mid single-digit earnings growth by some additional operating leverage and share buyback. So I think we'll probably hear the same for fiscal fourth quarter. I think we'll hear that the consumer spending was remarkably, resilient. The consumer has been very resilient through this cycle. You probably get greater cross-border transactions, international travel and spending higher. So themes are, remain pretty strong for Visa and Mastercard as well.
So the setup looks good for a couple of these names, and particularly because really the theme of this earnings season has continued to be one of consumer resilience, as you mentioned. You've got a buy rating on the shares with a price target of 411. We're at 349 and change right now. What gets us there?
Yes, so that's high teens type of appreciation from current. So we do see some good upside, and I think again it's that resiliency to the earnings growth story. For Visa, it is they have a lot of secular tailwinds, right? You have these cyclical tailwinds of improved consumer spending, but you have a lot of secular tailwinds also, which would include inflation, right? Inflation moves up to the extent the basket of goods costs more next year than it did this year and the year before. That's a positive for them in terms of overall spending. This has increased penetration towards digital spending away from cash and checks and slower forms of payment. We get wider merchant acceptance, a lot more merchants accepting cards or accepting lower dollar amounts for charges. And then you have consumers which are really looking to maximize their credit card rewards programs for either cash back or travel rewards and the like. So I think these are all positives, and Visa itself, the stock is rarely more than 10% from all-time highs. You get these minor pullbacks basically, and they wind up being a buying opportunity.
Yeah, and I mean, the street seems to agree with you. I mean, I see this consensus right now is for a buy. I mean, there is no one that seems to be in the underperform or sell camp right now. So the setup sort of looks favorable. I'm just wondering, you mentioned a couple of those other names that we did actually show the chart as far as the comparison in the performance with, Amex and also Capital One, etc. How does this one sort of stack up against the rest, and what are they likely to say that's going to be different?
Well, Visa has, if you think about certainly the market share that they have between Visa and Mastercard, you have something like close to 85% market share in terms of digital payment forms, and the rest is divided up between American Express and Capital One, which now includes Discover. But their story is one of, and their ability to differentiate, or it really is in the margin story. This is a company with 60% plus operating margins, a very enviable for any company, right? Considering that the average S&P 500 company is less than 20, and this beats technology companies, it beats most fintech companies. So that mid-teens earnings growth, I think, justifies these more elevated, you would say, PE valuation multiples of kind of 30, low 30s. But I think that's very justified. The other company you mentioned. Well, Mastercard is similar. Capital One and American Express, the differentiation here, the big one, is that Visa and Mastercard do not have any credit story, right? They don't have loss provisions. They don't loan to customers. That's done by the banks that issue the cards. In the case of Capital One and American Express, they do offer credit, so they do have in downturns, they have to set aside more provisions for that. So it adds a little bit of risk element to those other names. But Visa, very high margins, no credit exposure is, again, I think justifies towards those low 30s multiples.
Okay, we'll be watching out for those earnings that come this afternoon. Thanks so much for helping us set up that name and a preview ahead of that report card. Stephen Biggar, Argus Research there. Appreciate your time. Let's trade it now with Tom White, host of Fast Market. And you've got an example trade for us on Visa. What's the approach there, Tom?
Yeah, just kind of going off the back of the guest's commentary here. If you think this stock's going to go higher, remember it's about 6% off all-time highs with the overall markets at record levels. This is going to be a big barometer for how the consumer's doing overall. They get that data on a day-to-day basis from those swipes. So I looked at a strategy that's really short-term, that's going to expand in value if it goes the direction you want it. I looked at a bullish call butterfly, but I skewed it, made it a broken wing call butterfly to offset some of the costs on this bullish trade. The option market pricing in about a plus or minus 3% move. For a $350 stock, that's not a big move on a percentage basis. So implied volatility levels, while elevated, not as high as they typically are, as the stock's gone up about 10% so far this year. So going on to the October 31st weekly options, expire in just 3 days. We're going to buy one of the 347.5 strike calls. We're going to sell two of the 360 strike calls. And then we're going to buy one of the 365 strike calls. So in essence, you're buying about a $12.5 wide bullish call vertical, offsetting some of the cost by selling a $5 wide call vertical on this one with that same common short strike at or near 360, which is about that one standard deviation move that the option market's pricing in. You're going to pay roughly about a $370 debit for this bullish position. That's going to be your risk, $370 per spread. You can see here from the risk profile, you need it to go at or near 360, but anything above the break even of about 351.20 over the next 3 days is going to be profitability on this one. Now, you can see here from the risk profile that the profitability goes down past 360, but you're still going to have more than a double in profitability if it does go and continue moving higher back up towards 365. The all-time high was in June of this summer of about $375. So this is a relatively conservative way to kind of look at this. You only need the stock to go up about $2.5 from the current share price to get above that break even. So this might be the way to look at it. If you're bullish on the trade, but just moderately bullish, thinking it's going to go up, maybe that one standard deviation of about $10.
Okay, a good look at Visa there, an example trade from Tom White ahead of these all-important earnings this afternoon. And obviously it's been a story of consumer resilience. So let's see, they seem to be flying, they seem to be cruising, they seem to be hiring cars. Let's see if they are tapping the plastic as well or swiping or whatever you do with your Visa card.